Good afternoon, everyone. Today I'm joined by our Managing Director at Wessex Commercial, Graham Potts, for the third of our three-part series on exiting your business. We'll take questions as we go here on LinkedIn Live, so pop them in the comments. Graham, we've discussed starting with a health check and then secondly, a growth plan. So let's talk details about exiting. Where do we start?
Well, I think the most important thing, well, hello everybody. Most important matter is to make sure you look at what you want personally. What's your personal goals? So set clear objectives of what you're trying to achieve. What kind of exit do you want?
Okay, and what sort of things do people consider?
Well, personal, so let's go personal, as I call it. Health, how healthy, sort of retirement, do you want to spend more time with family, with grandchildren or whatever it is? Have you got other ideas, other hobbies? Mm-hmm. How long do you want to stay after selling, stay in the business? It depends. If you've got if you've been on the business and you've got a team that runs it, then maybe you can, sort of go quite quick, but if not, you'll probably be tied in for quite a period. How much cash you want and when, and always remember with that, that cash isn't the price that they say they're going to pay, because there are tax considerations. And with, we don't know with the government potentially changing next year, what happens if they change the rules, the tax breaks that you can get. And it's also the structure. There are different types of structure, which we'll go through later, that means different to how much money you're going to get. And then you have to look at things like market factors. It's a bit like when you look at the housing market. Mm-hmm. Prices have varied on demand. After COVID, market went stupid. Now it's quieting down. Acquisitions can be the same, but more that you've got people, the businesses that you want to, buy you, if it's a trade sale, they may be busy and they may not want to buy you today. They may want to buy you in 3 months, 6 months, 9 months time. So you've got to think about those, that it can be at different times. Keeping your staff motivated is key as well. Have you got good staff that are retained and on good contracts, so that actually that they're engaged? And what would you do after exit if you do leave? If you do leave quite early, how long, as you said, do you want to be tied in for? But also, what are you going to do? Because it's your life's your business, and then suddenly you're not there. You're not in control. Yeah. So how do you get through that?
Yeah, and we're always on about getting your business into good shape so that you can adapt to to any changes in your plans.
Yeah, exactly. So like I said, you've got to be flexible. You've got to be in, it's not, I want to sell, March 2025. You've got to be flexible in the timing, because what might suit you may not suit the acquirer. And also it can be, it can impact on price, etc. Do you have a buyer? We talked about that earlier, in previous LinkedIn lives, but, what's your alternative to sell? It's good to have as many options as possible. It's good to have, more people. If it's a trade buyer, you're going for that, more people, not more than one interested. If it's a management buyout, that's fine, but you've got to have the right management team, and you've got to make sure they're set up right to be able to take it over. Or maybe an employee, an ESOP, employee shares, where you sell it to the employees.
Yeah. I mean, most people wouldn't have sold a business before, and you've got loads of experience both buying and selling. So tell us, how do you actually sell?
Well, there's two types mainly. You sell the shares, mm-hmm. or you sell what's called the trade and assets, which includes goodwill. Okay. So when someone's buying the business, the assets, goodwill, etc., and one they're buying the shares, it's totally different.
And let me stop you on that one. I think people will understand what the share sales and trade and assets. But tell us a little bit more about what goodwill is.
Well, goodwill is the difference between your balance sheet value. Now you'll have the balance sheet, and we're going to do a LinkedIn live later on, early in the new year, about what is a balance sheet. Mm-hmm. But your balance sheet with your assets less liabilities has got a figure, your net assets, or your equity in the company. Now that figure actually is not probably the true value of your assets and liabilities, because there's with the assets, if you're thinking like a car,
Yeah.
Car you might be depreciating over 5 years. Now the values have actually been pretty stable and held up.
And you tend to depreciate things often on a straight line basis.
Exactly.
And that isn't how assets change value over time. Yeah.
Exactly. So the assets may be undervalued.
Yeah.
Just make sure there. But anyway, what's the real assets and liabilities? And say that comes to a figure of 100,000, whatever the figure is. And say someone will offer 250,000. And then the difference between the 100 and the 250 is goodwill, which is the value of your sort of like the customer base, your future potential work, your intellectual property, everything that you can't see. So it's called an intangible, but that's what goodwill is.
Okay. So, if a share sale or a trading asset and goodwill deal are the two main options, what are the other alternatives?
Well, you could sell part of the business. Maybe you have a business, like for instance, that either you want to keep yourself, like you may have property in there that you want to take out and do yourself. So you may take the property out and then rent it to the new owners. It could be, let's say you've got two in the same business, you've got two distinct type of trades, and maybe one the buyer wants and the other one you don't. Maybe you sell ice cream, or you make ice creams, you make umbrellas, and there may be a different, so there could be different things on that. There's a management buy-in or part buyout, where they buy part of the shares and you're still involved. Or maybe, in the business, let's take a scaffolding business. There's been quite a few scaffolding businesses that closed when the asset value went through the roof because they were struggling with fixed price contracts. So they closed the business and sold the assets. So you could do that, where you think you'll make more money just selling the assets yourself.
Okay, that makes sense. But again, most business owners are only going to go through this process once. So what actually happens when you sell a business?
Well, there's a lot of things. Well, first of all, you prepare. It depends on the size of business. If it's small and you're talking tens of thousands, you might just go on some online ones. But if you're talking about a decent, like, I don't know, hundreds of thousands, millions, you would generally prepare sales documentation.
Okay.
And you would put a sort of a whole document with the whole business, and it will be anonymized. But I'll just go back to this in a minute. So what happens, there's like 3 stages. First of all, you have a summary at the top. That summary goes out to loads of people, potential. You get one of the agencies that put it out in the marketplace that will not identify or should not identify who you are, but it goes to markets, and you would put it to the people that you want it to go to as well. So it goes out as anonymous. If people, that sort of 2-3 page document, if they're interested, because it says business and sale in the Southwest, scaffolding firm, sort of assets, £1 million worth of assets, 2 million turnover, whatever it is, profitable business, then that's what it's saying. It's very simple. It just gives a bit of a flavor. If they are interested, they sign something called a confidentiality agreement. You must get that, because a lot of these businesses will be phishing, and it gives you some ammunition if they pinch some of the information they're giving you. But what you do is you give that's a document already pre-prepared, and goes into more details, 20, 30, 40 pages, whatever it is. And that will still say, and that turnover is, say, 2 million, it'll break it down. And it'll say that's got these type of customers, maybe in different markets. Maybe it says in construction, in public sector, in maintenance market, whatever it is, or in the dockyards or power stations. And it'll break it down and say how much in that, but it won't tell you who the customers are. So you keep the customers, that's for the last stage, because you don't want people going after your customers. And it'll give information about your employees' numbers and everything, things like that. There's certain information it'll give. And then you go into trying to get in a bidding, sort of find a buyer. So that's, like I said, gone to the market. The people you've been approached with by the way, they would be part of this usually, but you generally go to the market.
Yeah.
And remember, you've got to have a lot of plan. We see the last 2 LinkedIn lives about getting your health check, get how you grow, and this is the last part. All right. Then you get into negotiating with the people and get the best deal for you. That's not always price. It may be because you might have someone who says, I'll give you 3 million, and someone gives you 2. But the 3 million might be on future potential. The 2 million may be cash. I'm going extremes.
Yep.
So you look at what's the best deal for you, and then you generally go to that one buyer. You go in and say, right, we'll hold back with anybody else. We're now go and say, and we're opens yourself up to that. You're basically now, I've got a deal. Now what's the next stage?
Sure.
So you've got a value agreed. It's sort of heads of terms.
And once you've got that value agreed with the potential buyer, what happens next?
Well, the next thing is the buyer will go in and will carry out their own due diligence.
Okay.
It could be, if it's a big company, they might do it themselves, but often they use a firm of accountants, maybe qualified chartered accountants somewhere, or another type of thing. They go in and look at the business. Now we're getting into, it depends where your records are, but often what's happened, if you're selling, you've put all the information up into like a data room, so they can just do it remotely, but they still want to come and see and check. So they'll go through those warranties, and then they'll want to see, go through the business, and then they'll want to talk to maybe customers, or, but you've got have to manage it yourself. You have to make sure, and this is where you need proper professionals with you, because otherwise you don't know what they're doing. So you give them what you want through a one source. Don't get your staff talking to them and they just get, so it's got to be controlled. What will happen once they've done that, they might find some things and then say, we've mentioned before in previous LinkedIn lives where I've been involved where we pulled out because they actually lied to us about a contract that was key to the business. But generally they'll look at it and say, I'm not happy with this, or I need more money held back because I'm worried about this warranty, or the price has gone down because you said it was this, but it's not. Those things, and you then look and negotiate, redefine the deal. Once you've done that and you're happy, because you can still pull out both parties, it's all subject to contract. A lawyer will draw up contracts, a sell and purchase agreement, and basically you go through that and you look at you look at what other contracts would be. There might be with yourself as owners. What usually happens, there's sometimes you might stay as an employee, but often you're put in as a consultancy agreement. But they will be there'll be restrictions on you. But there'll also be warranties. So you'll have warranties about, sort of like, you said this, if that happens against that, then we can pull some money back, and they'll hold money back as a like retention. That often happens. So there's lots of things that you go through then that before you get anywhere near doing the deal, and it can take at least 3 months, if not longer.
And just touching on something there about terms for the owners, there will be terms in place to prevent you setting up a similar business next door the next day.
Exactly. As you're selling this, it'll be, probably 3, maybe 5 years, something like that. Because you're getting value for it. That's much stronger than, say, an employment contract where, it's very hard to tie down those sort of terms because you're getting value. So they can stop you, and they will stop you like going into that business that's going to affect, you won't be able to poach the customers or do lots of things. So yes, you're absolutely right.
Okay, so let's move on to pricing, Graham. How are businesses typically priced?
Generally, it's generally a multiple of profit. So they all have different ways of calling it. You might have heard of EBITDA as earnings before interest, tax, and depreciation and amortization. Some do it profit before interest and tax. Some might do it after, but it's a value. It's a number on that. That gives you a value of what they think it's worth, and they're always looking at how quick they get the money back. So it's internal rate of return. So they'll look at that, and then they will say, right, how much would that be if I don't buy the shares and I'm going to buy the trade and asset? So they will look at the trade and assets and like be a price for that. So you could have, like I said, there's multiples of profit. There's the value of the stock assets. And what happens if you go down the trade and asset route, you're basically getting money into the company,
Yeah.
right? And then what will happen, then you have to take the money out of the company, but you have to settle all your liabilities.
Sure.
Usually that produces less cash because of the tax ways, but you need to take expert advice on that.
Yeah, definitely. And thinking about the risks that might come along, what do business owners need to look out for?
Well, if you offer warranties, you've got to understand what those warranties are, and what's the risk of comeback. What's the potential that they're going to come back to you on that? There always is some in business. There's some things you don't know. Maybe contract dispute, employee claims or whatever. You just don't know. So you put in a value, and they adjust that with the price.
Yeah.
But we always say, always be open and as honest as you can to avoid these claims. So there's something in the process called a disclosure letter, and you disclose certain things. You talk to us about how to make it the story right, but if you disclose it and it's in the documentation, they can't come back and say you didn't tell us. Whereas if, for instance, today when you're selling that you've actually got a potential employment claim and harassment claim or whatever, and it could cost you 100,000. You need to disclose that. Otherwise, they'll come back and say you didn't disclose it. We owe that money.
Yeah,
we want that money back.
Absolutely.
Or they take it off the retention.
Yeah. Okay. Where are we going next then, Graham? Is that if
Yeah, well, let me carry on with the disclosure. Like I said, could be employment issues.
Yeah.
Like I said about that. But also, I wanted to talk about if you agree to an earn out, right? You must know, and an earn out, for those that don't know, is that basically you've got some of the profits are dependent on how well you do in the future. Now, if that's the case, and they're most of these are like that, there's an element of earn out. You've got to know if you need that money, you've got to understand that you can control that future performance. And are there any funnies in there? What happens? It's all right saying, "Oh, we continue to make $500,000 a year," but what happens if they put their own management team in, or they basically put in intercompany charges or whatever? You've got to know so you can understand how much that is. There's no funnies. And if you don't understand accounts, that's a bit of a problem. So you need someone to help you with that, because you're talking a lot of money. And also, I'd say post-sale involvement, is it suitable for you? Are you interested in short-term consultancy or phasing out? Often we look at going like sort of down. So, you agree a deal that's, for, a couple of years, but you've got to make sure that they want you to, if there's things that's key in the business for you, like is dependent on you, they want you involved.
Yeah. And it will feel very different, won't it, being in as a consultant rather than the owner. And I think that's something that people have to take into account. And, if your earn out money is dependent on it, you've probably got some of those same incentives, but it can be quite tricky.
Is. I mean, it's exactly like, it's a marriage, and you've got to think about what happens. But, when you get married, you've got to think about someone else. Now, you were in control of your own destiny. Now you've got someone else who actually, might be the boss. So this is to actually work when you've worked for many years, maybe, and you've been your own boss. Suddenly you're not. And that is hard for people to understand and to get over. So just be prepared for that.
Definitely. So how do people know that they're getting a good deal?
Well, from what we said before, are you achieving your goals? So set out goals before you enter the process, and ensure that it meets not only your financial but the personal goals. So if you're like, for instance, if you're thinking of a price, just don't think you're going to get that price, and think what you need in cash. So have a bit of a range in there. Definitely got to make sure they're a genuine buyer. That's why you need professional advice to help. Can they pay? Do they, do your own due diligence on them. If they've bought companies before, talk to them. Talk to the people that's been bought out. Sort of, are they part? Do they feel valued? Did it go well? What was the problems, or were they sharks? You just don't know. Do your team, your employees feel confident with them? What's their long-term, because a lot of people want their baby to continue and grow. So they want the team, they have emotional bonds. So
Yes.
what's the long-terms for their long-term plans for the business and for the employees?
Yeah.
And does it make commercial sense? And like we say, do you feel happy to hand your business, your baby, over to them?
Definitely. Really important questions. So how would you summarize that advice, Graham, for business owners that want to exit the business and go through that sales process?
Yeah. Well, I would say, there's a lot more to this than that. This is just a very little snapshot. But obviously get professional advice, number one. Even if you don't, just talk to a lot of people, just people that's been through it before, so you can understand, that's been through the same sort of size of business that's going.
Yep.
Start by setting your personal goals, and put yourself in the potential buyer's shoes. They want to buy a business with good profit margins and cash flow that's going to grow and give them bigger returns. So they'll want to get their money back over a period of time. Often, maybe 3 or 5 years.
Yeah.
So how are they going to get that cash in the business coming through? Or, understand your buyer. Is it a PLC? And what they're after is a chunk of profits that they can buy your company for 5 times earnings or profits. But in their share values at 20 times, in which suddenly their share value goes, whoa. And that's what you'll find with a lot of the acquisitive sort of companies out there. That's what they're doing. They're trying to build this Goliath, and it's all about getting the share price and their options up. What do you want, cash now and in the future? And how involved do you want to be in the business going forward and not? Because I have seen people that want to stay there and just potter around. So what do you want? But deal with all issues now. It's time to get rid of and disclose any skeletons in the closet. Don't don't hold them back, because if they come out, they could come back and really bite you.
Yeah.
Look at market factors, how it affects price, timing, like I said, there's a price here. Are you going to get all the money to start with, or is it earn out? Then you've got things like tax. Is it, trade an asset? Because it could be like a bit of a double tax there. So there's so much to think about, because all you'll be interested, I want X. Well, X that you get is not what Y is, what they pay for the business. So you've got to work out is, when do I get what cash and what's it mean to me? Keep your staff motivated. As you go through this process, it is bloody time. I don't know how I'm saying probably, but it's very, very time intensive. I've been through it where it just sucks in the management time. So if you're on the business, it's okay. But if you're in the business, you've got to be careful that the business doesn't go down. Because I have seen it where I've heard, and I've seen it where the business are going down, and basically all they're after, these sharks are trying to come in to get it on a cheap. So they could suddenly at the last minute suddenly say, oh, I was going to pay 2 million. It's not really worth that. It's 1 million because I've found this and this and this. And you're so I've got to sell. So be very careful with that. You've got to have the business running on without you, and it just keeps on making money. And what do you do after exit? There's a lot of saying where business owners have struggled afterwards. You've got to have hobbies, or, looking at with family, going on holiday. What are you going to do? Because are you going to have a little, do some voluntary work? What are you going to do afterwards? Because that is a key thing, because it's not just the financial, it's how you feel, because you've put all your life into it and then suddenly it's gone.
Definitely. There's an awful lot to think about, isn't there? And if people are, at that stage, or really actually planning ahead and want to have a conversation with you, Graham, we're offering a free one-to-one session. So pop an email over to chatwithgraham@wessexcommercial.com and we'll set that up. And that brings us to the end of our sort of mini series on getting exit ready. But next time, we're back on Monday, the 4th of December at 12:30 p.m. With a common question. My accountant says I'm profitable, so why don't I have any cash? We'll be answering that question with you on Monday, the 4th of December. Thanks everyone for joining us today, and we'll look forward to seeing you then.
Thank you very much. Goodbye.